In 2019, Imperial Brands faced a major challenge in the United States, one of its key markets for vaping products and e-cigarettes. The company, which sells vaping gear under the brand name Blue, saw its sales growth and profit expectations plummet as a result of a regulatory crackdown on vaping products in the US. The crackdown was triggered by a spate of deaths and illnesses linked to vaping, which raised concerns about the safety and health effects of e-cigarettes. The U.S. Food and Drug Administration, FDA, announced a ban on most flavored e-cigarettes, which are popular among young people, and threatened to pull all vaping products from the market if they did not submit applications for approval by May 2020. The FDA also launched a criminal investigation into some vaping companies, including Juul, the market leader. These actions created a lot of uncertainty and fear among consumers, wholesalers and retailers of vaping products in the US. Many of them stopped ordering or promoting vaping products, fearing legal repercussions or public backlash. This had a significant impact on Imperial Brands, which had invested heavily in building its next-generation products, NGP business, which includes vaping products and e-cigarettes. The company warned that its NGP sales growth would be lower than expected in the year ending September 30, 2019, and that its overall revenue growth would be around 2%, instead of the previously forecast 4%. It also forecast zero profit growth for the year, compared to its previous guidance of 4% growth. This was a shocking profit warning that sent its shares tumbling by 10% on September 26, 2019. Imperial Brands faced a regulatory crackdown on vaping products in the United States in 2019, which led to a zero profit growth that year. This was a major setback for the company, which had hoped to use vaping products as a way to offset the decline in traditional tobacco sales and reinvent itself for the future. One of the strategies that Imperial Brands used to survive the crisis and maintain its growth was to increase cigarette prices and exit some markets such as Russia and Japan. In this section, we will explain how this helped the company offset the impact of lower volumes and losses in its next-generation products, NGP business. Imperial Brands is one of the world's leading tobacco companies, with a portfolio of brands such as Davidoff, Gauloises, West and Kool. The company operates in over 160 countries and has a market share of about 10% globally. However, like many other tobacco companies, Imperial Brands faced challenges in recent years due to declining smoking rates, increased regulation and taxation, and competition from NGPs such as e-cigarettes and heated tobacco products. To cope with these challenges, Imperial Brands implemented a turnaround plan in 2021 that focused on its 5 top markets: the United States, the United Kingdom, Germany, France, and Spain. These markets accounted for about 75% of the company's tobacco net revenue and 85% of its tobacco profit in 2022. The plan aimed to improve the performance of its core tobacco business by increasing prices, reducing costs, investing in innovation, and enhancing its brand equity. One of the key elements of the plan was to increase cigarette prices across its markets to offset the impact of lower volumes. According to Reuters, Imperial Brands raised its cigarette prices by an average of 7.5% in the first half of 2023, which helped the company boost its operating profit by 27.5% to £1.53 billion, $1.93 billion, in the same period. The company also achieved strong pricing in its top 5 markets, where it gained market share in aggregate. Another element of the plan was to exit some markets where the company had low profitability or growth potential. For example, Imperial Brands decided to withdraw from Russia in 2022, citing regulatory uncertainty and a challenging operating environment. Russia was one of the largest tobacco markets in the world, but also one of the most competitive and regulated. Imperial Brands had a market share of less than 10% in Russia and faced pressure from cheaper local brands and illicit trade. Imperial Brands also exited Japan in 2022, where it had a small presence in the NGP segment with its Blue e-cigarette brand. Japan was a leading market for NGPs, especially for heated tobacco products such as IQOS by Philip Morris International and Globe by British American Tobacco. However, Imperial Brands struggled to compete with these rivals and face regulatory hurdles and consumer preferences that favored heated tobacco over e-cigarettes. By exiting these markets, Imperial Brands was able to free up resources and focus on its core tobacco business and its NGP portfolio in other regions. The company said that it expected to generate about £600 million, $757 million, of cash proceeds from these divestments by 2024. However, despite these efforts, Imperial Brands still faced challenges in its NGP business, which included e-cigarettes, heated tobacco, and oral nicotine products. The company reported a 19.8% increase in NGP net revenue at constant currencies in the first half of 2023, driven by product launches in Europe. However, this was partly offset by declines in the United States, where the company faced regulatory uncertainty and increased competition from Juul and other vaping brands. The company also reported a loss of £59 million, $74 million, from its NGP business in the first half of 2023, compared to a loss of £72 million, $91 million, in the same period last year. The company said that it was taking actions to improve the profitability of its NGP business by reducing costs, optimizing its portfolio, and enhancing its innovation capabilities. In conclusion, Imperial Brands increased cigarette prices and exited some markets such as Russia and Japan to offset the impact of lower volumes and losses in its NGP business. This strategy helped the company survive the crisis and maintain its growth in its core tobacco business and its top 5 markets. However, the company still faced challenges in its NGP business and needed to improve its profitability and competitiveness in this segment.